one, happily, everybody got it except one. That's a big problem, right? Still, one person missed this one because I told you that this is the only slide we went over before this quiz. So you should get it, but some people, one person missed this one. The net present value gives a direct measure of dollar benefit of a project to a firm's shareholders, which is consistent with shareholder wealth. That's correct. Since the NPV rule is the best, you do not have to consider, that's wrong, right? NPV rule is the best given some conditions, and other ones are correct. That's almost the same as a slide. So good news is that almost everybody got it correct. That's good. And today we'll continue chapter 13. So last class, we talked about how to kind of summarize or simplify income statement part, this one, right? We use income statement to get, net income, and net income plus depreciation, that is operating cash flow. But now, as I showed you this one, step by step, this one, the final one, like 375,612, that one is simply revenue times omega t plus depreciation times t, right? So now we don't have to go through income statement way, but just revenue times after tax revenue, right? After tax revenue, for example, 380K times omega t plus depreciation 364.60. Where is it? We are doing this one, the second year one, right? For 9 is 061 is depreciation times tax rate, then you get this one. For 18, and this one, 375,612 is this one. 375,612. So this formula will make it easier, right? So you have to remember this way. And so far so good. But many people miss this part, terminal net cash flow. Because terminal net cash flow, you have some additional cash flows. First thing is recovery of net working capital, right? As I said, the assumption is that net working capital level will go up in time zero, right? Time zero. And it will stay during the life of the project. And at end is what? End of project, it will go down to its original level. So asset goes up in time zero, cash outflow. Asset goes down at time end as cash inflows. So we have net working capital recovery, 15,500. And sale price, so when you make a sale, then what? The cash into your pocket. But many people miss this part, tax on gain. You don't have to pay tax on a whole sale price. You only tax on gain. Then how to calculate gain? Then you have to compare sale price and book value. And how to calculate book value? That is, you have to go back to here, right? So here, if we book value, right? Book value. Then what? Book value equals basically depreciable basis minus depreciation. Each year. I think this is not each year. That can be misleading. Yeah. First year, right? And book value equals book value of previous year, book value of previous year minus depreciation. Now each year. So first year depreciation is depreciable basis minus depreciation. Now each year from second year, then book value of previous year minus depreciation. So book value wise, the value of the machine is just original book value minus each year's depreciation. So the value of the machine decreases by the amount of depreciation each year. So according to that, book value first year, t equals 1, that means at the end of first year, that is what? Then depreciable basis is
1012.5?
Yeah, 1102.05, thank you. 1102.5 minus first year depreciation 367,463. This is in thousands and this is not in thousands, right? So this is in thousands, right? In thousands. And this is just actual number. In 000 thousands, 1,000s. And this one, depreciation is actual number. So 367,463. So in thousands is 367.463. There is book value after first year, right? Let's just stop share for a while. And
Professor, I have a question on how this could relate to like a building. So if you depreciated your building each year and you go to sell it for how much it's like the market value, if the book value shows a really low amount, does that mean you're taxed on all the amount like it says you gained from it? So if you depreciated a lot, you pay a lot of taxes?
No, if it is depreciated a lot, then what? Then your book value will be smaller, so you pay smaller tax. Oh, wait.
Wait, I thought you paid the difference of the book value versus what you sold it for, because that would be typically like the gain.
Oh, you're right. Yeah, right. So you pay more tax. Yeah.
So if that were a building and you depreciated a lot, you'd pay more.
You're correct. Yeah, you're correct.
Okay.
So the more depreciation means more just profit, so more tax.
And the same goes with like a house. So if you owned a house and you depreciated it every year in your taxes and you went to resell it, you would pay more taxes based on how much you gained.
Let's check the house. If you sell house, let's say if you sell house, there is a I think that is not an operation related, right? So if you use a machine that is operation related, right? If you use a machine that is operation related, but house, I think it depends. Yeah, your house is
A building
your,
company can own a house though.
So then that can be investment, right? So if the house is used as a business, right? If for example, a house is, if you have like a rental business, then you have to include as a cost. So it all depends. So it all depends on whether the machine or property is used for your business or not. Yeah.
Okay. Yeah. Thank you.
Good point. So 1102.5 minus 367.463 and 73504. So that's first year book value. So this is book value, right? First year. So book value at t equals 2 is, so book value previous year, so this one, 735.04 minus that year's depreciation, 490.061. Minus 490.061. 24498. Book value at t equals 3 is 244.98. Previous is depreciation minus each year's depreciation. So that year 3 depreciation is 163,280. This one minus 163.28, 8170. And
Professor,
yeah.
Are those, you're not putting 367,463, you're putting 376.463?
Yeah, because this is stated in thousands, and this is actual number, so you have to be consistent, right? So I put 367,463 in thousands, then 367.463 in thousands, right? I can either make this one 102.5 in real number, that is 2,500, right? We can do that too, but to save space, just in thousands. So everything is in thousands. Then t equals 4 is simply 81.70 or 81.70. Last year, the depreciation 0, 81.70. no, sorry. The other way around. Minus 81.70, 0. So Baker's no salvage value, so it's 0. Book value will be 0, right? But this one, they operate for 3 years. End of 3 years, book value is 81.70, right? So that is how to calculate book value. Or you can do it using percentages. Like this one is 0.3333. So you can, after 1 minus 0.3333 is 0.6667, right? So that this one is 0.666, then 4 decimal, 667 times this one, okay? In year 2, 0.3333 plus 0.4445 is what? 0.7778. So you will have 0.2321. 0.2221, right? 0.2221. This is and this one is so this one is actually this one is 0.2221. Sorry. Point 0.0741. Sorry. This 0.2221 is correct. Yeah. Like this, right? So for example, in percentages, right? That of depreciable basis. So for example,
wait, how did you get the 0.6667?
That is actually in percentages, like 1102.5 is 1, right? Percentage, 100%. 1 minus the first year depreciation, 0.333.
Oh, I see. Okay, thank you.
Yeah, good question. Then what? That is this. Then this one is 0.6667 minus this one is 0.4445 in percentages, right? Minus 0.4445. That is 0.2222, right? Put the 222, more accurate. Then this one is 0.2222. This is 244.98 is 0.2222 minus 163. That is 0.1481. That is 0.0741, right? So you can do this way too. For example, if you calculate year 3 book value, then what you can do, 1102.5 times 0.0741, 81.7, right? We can solve that too. So those ones, see, this is 0.6667 over book depreciable basis. So you can, this is more, this way is more understandable, right? Each year you subtract depreciation, then each year's book value, right? And then beginning of book value minus depreciation is end of year book value. This is more easier to understand, but this way may be faster, right? Because just this one is not faster, but this one, rather than going through all these ways, you know, this one is only 0.741 of book value, 0.741 of depreciable basis. So depreciable basis times 0.741 is 81.70. Or year two, also it's easier for you to multiply. So using percentage is like, we can say 81.70 is depreciable basis 102.5 times 0.741. You can get 81.70 this way, right? So that is, I just took some time because this is where many people miss, right? Many people miss. This is a, believe it or not, is typical part. Many people miss calculating book value. Once you calculate book value like this, right? Then let's go back to here. Then we understand 81,695. This is because what? We use real number, and before some rounding errors, 81,700, so $5 difference, right? But this problem will go away in the exam because we are gonna use simplified, again, as I said before, like 33%, 45%, 15%, and 7%. We'll use this one, so this discrepancy will go away. So by the way, so this is simply depreciable basis times its weight. Then that's book value, right? And then what? Sale price is 605,000. Book value is only 81,695. So what? By selling the machine, you made a huge profit because book value is only 81,695, and you sold it at 605,000. So 523,305, there's profit. So tax on profit, not tax on sale price, right? Be careful. The tax principle is what? Where there is profit, there is tax. So you tax on profit. So 523,305 times 0.35, 183,156.75. So that is tax. And that is negative because tax is negative, right? But, you know, in the exam or homework or quizzes, whatever, what do you think if book value is greater than sale price? What do you think? And how would you handle that?
It would be treated as loss.
Check. Then what happened?
You wouldn't be carried forward to a different year.
Check. Then what? Then what will be the tax?
Would it be zero in this case, or would you use it from a different project?
Check. We assume that will use it on other projects, and the other projects' profit can be lower if you apply this loss, right? So there will be tax savings. So that's why you should not miss the class. You know, our assumption is that you have and that's pretty just reasonable, normal, right? the company doesn't have just one project. They may have many, many projects. So this project's loss can be applied to other projects' profit. Then what? Tax will be lower. Then what? That's tax. Then tax savings. Then I told you that savings is what? Cash inflow. So in that case, tax savings will be positive. So many people think that a tax is zero, profit, no loss, so no profit, no tax. Wrong. We have to apply that to other projects' profit. So tax will be positive, right? Then what happens if sale price is same as book value? Wrong answer is better than no answer.
Nothing.
Tax is zero.
Check. No profit, no loss. Tax will be zero. So if I cannot twist too much. Only there are three ways. So if sale price SP, sale price as book value EV is greater than book value, and tax is cash outflow. So you have to pay tax. So it's a negative cash flow. If SP is less than book value, tax is cash inflow, positive cash flow. If SP equals book value, tax is zero. No tax. Three cases. So now so don't forget that many people just multiply sale price by tax rate. That's wrong, right? You have to make sure that you have to compare sale price and book value. So if there's profit, tax. If there is loss, tax savings, positive cash flow. If the sale price and book value is the same, no tax. So this part is the most important. This is where many people miss. Then what? Then terminal cash flow is you add this net working capital recovery, sale price, and tax. Then you have 437, 343. Then now it's like this. 3-year operation, 1 to 3. Then those ones are OCF, operating cash flows, right? OCFs. And then what? So interim years, operating cash flows are just net cash flows. That's it. But year 3, terminal year, not only operating cash flows, but also terminal cash flows are there. So you have to add operating cash flows, terminal cash flows. So this is net cash flow. So initial year cash flow, net cash flow 0, net cash flow 1, net cash flow 2. This is net cash flow 2. But year 3, this is net cash flow 3. So all you have to do is just discount all those ones. But we have cash flows, right? Cash flow. So using our cash flow, second clear TV, 1118,000 is negative, right? Enter. C1 is 375,612.05. Enter. C2 is 418,521.35. Enter. F3 is what? 741. 491.25. Enter. Net present value, I is 12% given, right? 12. 12 enter. Down arrow, compute. 78789.39. Huge NPV, positive NPV, so accept. That is how to evaluate new projects, okay? That's relatively easier compared to replacement project, because new project, you don't have to worry about opportunity cost, just new project itself. But if you replace old project with a new project, then what? There will be opportunity cost involved. So that's more difficult. So many people miss that replacement project.
With Professor, what did you put for CO3?
What's the question, Steve?
What did you put for CO3 on the cash flows?
CF3 is this one, yeah, this one, 741,491. So that's only you enter net cash flows. Net cash flow 0, CF0, CF1, CF2, and CF3, and this one is CF3. Those ones so only year 3 is the problem. Year 3 is you not only have operating cash flows, but also what? Terminal cash flows. So you have to add 2. So this is 741,491.25 is cash flow 3. Any other question?
Wait,
Do you
so
mind going over that just one more time on the calculator?
Oh, sure. So this one, so let me just write down more time. That is what? Year 0, this is not dark enough. Year 0 is what? Minus 1118000. Year 1, 375, 612.05. Year 2, 418, 521.35. Year 3, 741, 491. So this is cash flow. So all you have to do is go to cash flow. Year 0, 1118,000, right? Negative, don't forget negative, right? And year 1, down arrow, 375,612.05. Year 2, 418,521.35. Year 3, 741,491.25. Right? You finish your data entry, then go to NPV. So it's just simply CF and NPV. So hit NPV right next to cash flow. And I is 12%, right? It's given in the problem. And the 12 enter, right? And down arrow, compute. Then what? 7878939. Okay. Any other question?
yeah, I get calculate terminal net cash flow, but how would you describe it? Like, how's it defined?
What do you mean?
I understand how we calculate the terminal cash flow, but what is terminal cash flow? Like, how would you explain that?
Oh, terminal cash flow is the cash flow associated with terminating the project. Right? Year 3 is what? Termination year, right? And year 1, 2 is interim years. The project is still going, right? But year 3 is different. Year 3 is you finish the project, terminate the project. Then what? Then there are costs or cash flows associated with terminating the project. And that is this one. That is terminal cash flow. So then what? As I said, the net working capital doesn't change throughout the years, but at the end of the project, net working capital goes down. That means what? Cash flow goes up. Okay. Asset goes down, cash flow. So that only happens when the project finishes, right? During the project years, we assume no change in net working capital. So this is not in year 1 and 2, but this is year 3 because what? You finish the project, so you don't need any more additional just inventory, right? So that you save inventory. So saving is positive cash flow. And then year 3, you sold the machine. Then what? Only when you finish the project, you sold the machine, right? During year 1 and 2, you use the machine, right? So this is, the sale price. When you sell the machine, you get sale price, right? Into your pocket. So that's why it's positive. And then what? Then the most important is, not important, but most difficult part is tax on gain. Okay, you have to calculation of tax, right? And then what is tax on gain? It's not on the sale price. Then what? How to calculate gain? You have to calculate book value. So you compare book value and sale price as I did here. So here, your sale price is greater than book value. How much? 523,305. That's a profit from sales. Then what? When there is profit, there is tax. So you multiply tax rate, and this is tax. And that you pay tax as a negative, right? Negative tax. So that's also related to terminal year, right? You pay tax because you sold the machine, and you sold the machine because you finished the project. So that's why we call it terminal net cash flow. That's why only in year 3, not only operating cash flow 304,148, you add terminal cash flows. That's cash flows related to terminating your project. Then both are cash flows in year 3. So you add them. Then what? Then 741,491.25 is net cash flow 3. Okay. A good clarifying question.
Question, the recovery of net working cash flow or net working capital, sorry, is that, or net cash flow, sorry. The 15,500, is that given or?
Oh, that is given.
How did we?
Yeah, that is given. So let me, good question. Let me read the problem 7. That is given. That is what?
It's on slide 2.
It says that
Changes in working capital. Okay.
is, where is it? Not this one. Is problem is 6 or problem 6, 13.6. It says that here the machine would require an increase in net working capital, for example, inventory of 15,500. Yeah, that should be given. Yeah. So this problem solving is based on the problem. Yeah. Problem 13.6, and that 15,500 is given. And then as you see, 15,500 is in the beginning is changing net working capital as negative cash flow, because asset increase is about cash decrease, cash outflow. So in the beginning, you have changing net working capital as negative cash flow, and at the end of the project, recovery of net working capital is positive, right? So your net working capital actually went down. Then what? As it goes down, cash flow goes up. Yep. Okay.
I have one question,
Then,
Professor.
yeah,
It's just a quick one. I saw at the final your NPV is 78,789. And then you chose to accept it. Is that just because it's positive?
check.
Thank
Good
you.
answer. Yeah, you're welcome. So decision rule is that for NPV method, net present value method, you take the project if NPV is greater or equal to 0. Since you asked, let me ask, then what is the decision rule for IRR rule? Anybody? Anybody? Just what is the decision rule when you use IRR method?
Greater than 1, maybe?
Well, there's profitability index. That profitability index greater than 1 or equal to 1 is you take the project. But IRR method, what's the decision rule? IRR rule is what? So profitability index greater or equal to 1. NPV rule greater or equal to 0. Right? And IR rule greater or equal to what?
Is it whack?
Check. Good answer. What? The cost of capital. Be careful. Multiple choice, somebody says that IRR greater or equal to 0. That's wrong. That's too low. IRR has to be greater than your cost of capital, not 0. NPV is greater or equal to 0. Okay, so that's a review. And then replacement project is more difficult because, as I said, this one includes opportunity cost. That is page 534. So let me read it. So the Gilbert Instrument Corporation is considering replacing the wood steamer it currently uses to shape guitar sides. The steamer purchased just 2 years ago is being depreciated as using a straight line basis. Straight line, right? Straight line means what? Just number of years. Depreciable base divided by number of years. And has 6 years of remaining life. Its current book value is 3,900, and it can be sold on an internet auction site for 4,500 at this time. Thus, the annual depreciation expense is, the book is wrong. The book is wrong. That is not 4,100, but 3,900, because its current book value is 3,900. So 3,900 divided by 6. Why? It's just straight line depreciation. So number of years. So depreciable basis divided by number of years. Remaining depreciable basis, because what? 2 years has passed. 2 years have passed. So 6 years remaining. So current book value divided by 6. Then 3,900 divided by 6, 650 per year. If the old steamer is not replaced, it can be sold for 800 at the end of its useful life. In other words, if you don't replace it, then what? The old steamer could be sold for 800, then what? But if you replace it, then you cannot get 800. So that is opportunity cost. And also annual depreciation expense of old machine, 650, is also opportunity cost. You cannot deduct that, right? If you sell old machine, right? That's the difficult part. Then Gilbert is considering purchasing the side steamer 3000, a higher end steamer, which cost 4,000, a new machine, and has an estimated useful life of 6 years with an estimated salvage value of 1,500. This steamer falls into the maker's 5-year class. Okay, so 5-year, 3-year, all depends on nature of the equipment. So the applicable depreciable rates are 20%, 32%, 19.2%, 11.52%, 11.52%, and 5.76%. The new steamer is faster and would allow for an output expansion. So sales would rise by 2,000 per year. Okay, this is sales increase, a revenue part, 2,000 per year. Even so, the new machine is much greater efficiency will reduce operating expenses by 1,900 per year. So reduce means what? Save money. So that's also positive cash flow. To support the great sales, the new machine would require that inventories increase, net working capital increase. Inventories increase by 2,900. But account payable would simultaneously increase by 700. So account payable increase is what? Liability increase, right? Liability increase, then is what? Then that is cash inflow, right? Asset increase, but but liability increase is what? So asset increase is cash outflow. Liability increase is what? Cash inflow. So Gilbert's marginal tax rate is 40%, and its WACC is 15%. Should it replace the machine? So that is typical question, and this is a main point of the question. So all the machine is depreciated using straight line depreciation, and book value is 3,900. The NV is market value, sale price. Okay, this is market value. Market value or sale price, 4,500, and 6 years of remaining life. And this is what I'm saying. So book value, because straight line depreciation, book value divided by 6 years of remaining life, then 650 per year depreciation is foregone. That is what? Because you sell this machine, you cannot get that depreciation, opportunity cost, and can be sold at 800 after 6 years. And this one is also gone. Why? Because you cannot sell old machine after 6 years. If you sell old machine right now, you cannot sell it after 6 years, right? So those ones, these two are very important. Right? That makes this replacement project different from new project. So opportunity cost. Then new machine is cost 12,000, 40% tax, 50% WACC, and 6 years of useful life with 1,500 salvage value. Then what? Maker's 5-year class, those one, so those you don't have to worry about these rates. Those rates will be given in exam or quiz or homework, so you don't have to memorize this. And additional information is because of new efficient machine, sales will up by 2,000 per year. So the cash inflow, expenses down by, this is both of them are cash inflow. Expenses down, expense savings. I told you savings is positive cash flow. So total 3,900 per year cash inflows. And inventory, net working capital up by 2,900. Accounts payable up by 700. Inventory up is what? Cash decrease, right? But account payable up is cash increase, right? So initial year cash flow is very important because there is also tax involved. Sale of old machine 4,500, but what? Book value is 3,900 is given in the problem, right? So 600 profit times 40% and tax. So that's why it's negative. Then what? Then you have to have cost 12,000 because that is what? Machine price. And again, inventory increase, so it's 2,900, right? Same as it's negative. But accounts payable increase is 700, right? So we
Wait.
have
Accounts payable increased by 700.
accounts payable increase means cash flow, positive cash flow. Is that your question?
But why did it increase by 700?
Because accounts payable is, from your chapter 7, asset goes up, then what? Cash flow goes down. But liabilities goes up and cash flow goes up, right? Because if you increase account payable, then what? You are not paying cash, right? You're saving cash. So what? A positive cash flow, right? Rather than paying cash, you promise to pay, right? That's what accounts payable, right? So you're saving money, right? So that's why it is cash inflow. Well, inventory increase, as you know, is for you to buy inventory, you have to pay money. So that's why it's negative. So accounts payable increase is positive cash flow. Inventory increase is negative cash flow in the initial year cash flow. So if you add them up, 4,500, 240 negative plus 12,000 and negative 2,900 and plus 700, then what? You have negative 9,940, okay? So that is, so if people miss, many people miss because of this, okay? Tax, right? Be careful, okay? Principle is simple. Sale price minus book value is taxable profit. Of course, same thing applies. If sale price is less than book value, then what? Tax will be positive, okay? Be careful. I can twist only by that degree, okay? Then, now, this part is very important. Operating cash flow. So sales increase 2,000. Expense reduction still positive, right? Saving is cat plus cat. So total is what, as I said, 3,900 is, total revenue. Then due depreciation is what? Baker's 5-year is what? 0.2, 20%. And depreciable basis is 12,000. The reason is we don't have any other, it's not given, like shipping or installation or modification costs are not given. So you just simply book the equipment cost, 12,000 times 20%, right? Then there is new depreciation for year one. But this is important. Your old depreciation is opportunity cost. Why? If you didn't sell the old machine, you could have used this 650, right, every year, but you cannot use it. So opportunity cost should be subtracted. This is important. Opportunity cost should be subtracted. So your total depreciation, I mean, new depreciation minus all depreciation, that is net depreciation. So this is important. So don't forget, okay? So OCF is using our revenue times 1 minus T plus depreciation times T, this one, right? So but this depreciation is net depreciation. Oh, new depreciation minus all depreciation, 1750 times 0.4. And total 3,900 cash revenue times 1 minus T. And so this is probably the most important slide of this problem, okay, operating cash flow, because you have to make sure that it is net depreciation, not new depreciation, because of this opportunity cost. Once you know that,
So
yeah.
Professor, so 3,040 is. I'm trying to like how to calculate that.
Well, since you ask, let's just calculate. So 3,900, right, times 0.6 equals 2,340. So store that at 1. Then what? The plus 1,750 depreciation times 0.4 tax rate, 700. So 700 plus, we call 1, 3,040. Yeah, this is just this one. Okay, that is.
Oh, okay.
Yeah.
So I thought the parenthesis like 3,040 times that one. You know what I mean?
Yeah. So
you know
yeah,
what I mean?
maybe, yeah. So maybe I have to write, maybe put big bracket like this. So that is this one. That is this one, not this one. That is this one. Yeah. OCF is revenue times 1 minus T plus depreciation times T. This one. So very, very important. This is the backbone of cash flow analysis. Okay. OCF, revenue times 1 minus T plus depreciation times T. A new project analysis, you just multiply tax rate to this machine's depreciation, right? Simple. But the replacement analysis, you have to have not only new machine's depreciation, but also you have subtract old machine's depreciation. So it's a net depreciation. So that's why it's 1,750 times 0.4. Okay, revenue minus 0.6 plus. Okay. Thank you for asking. Yeah, please ask questions if anything is not clear. And then what? So I told you that this is the most important slide because this one is basically what? Repeating just this slide for every year. So like this, depreciation 2 is what? This is what? Due machines depreciation minus old machines depreciation. Okay, so everything is this one, right? This one is explaining the number in front, right? All those ones, explanation how to get those numbers. Right?
Professor, I have a question.
Sure.
Why do we have to subtract opportunity costs? Like, why don't we just calculate the cash flows if you were to keep the machine versus like the new machine and then just subtract them at the end? Like, why do you have to subtract the opportunity cost?
That's a very fundamental, very important question. Yep. Because, you know, by selling old machine, you are losing this benefit, right? So that is opportunity cost. For example, if you didn't sell the old machine, but you could have used 650 to deduct, right? But by selling the machine, you cannot deduct. So this is an incremental cash flow. In other words, whether your decision affect the cash flow or not, that's very important, right? So your decision affect that cash flow. Why? Because you replace old machine, you are losing that cash flow. So that is why that is an opportunity cost. Okay. So then what? When you evaluate projects, you have to make sure that you include all the relevant cash flows. We call it incremental cash flows, right? So incremental cash flows are cash flows that are affected by your decision. Definitely, because of your decision of replacing older machine, you are losing 650. So that is negative cash flow. That's why. So if this is a new project, then what? 12,000 times 0.32 is new projects depreciation, right? This is new projects depreciation, right? But this is all the projects depreciation. So that's why you subtract. If this is a just new project analysis without any replacement, then what? This is depreciation, so you can deduct this much. But because you replacing older machine, you are losing this deduction, right? So that's why you subtract. That is correct way of analyzing things. Okay, if you forget opportunity cost, then your project net present value may be too high. Okay, because you are not thinking about losing money. Okay, you are only thinking about earning money. Okay, so very important to subtract opportunity cost.
That makes sense. Thank you.
Thank you for asking. Yeah, very important. Yeah, so understanding is more important than just blindly, plug the numbers, right? That's a good question. So here, so you just do the same process, because this is what Baker's rate, second year 32%, third year 192, fourth year 1152, fifth year. So depreciable basis times rate, that is new project depreciation. But this one is staying because the old machine was depreciated by straight line. Yeah. So that is depreciation for each year. Then what? Each year's operating cash flow is what? Revenue times 0.6 is the same. This revenue times 0.6. But each year's operating cash flow is different because what? Depreciation is different. Right? Depreciation times tax rate. Depreciation times tax rate. So this part is just repeating this slide each year. Okay, so this is just adding not much. Then what? Then again, many people miss this part. Terminal cash flows, terminal cash flows. Again, terminal cash flow means what? When you terminate the project, additional cash flows associated with terminating the project. That is actually, this should be in the previous slide. Those are operating cash flows. So terminal cash flows are those ones, right? So operating cash flow plus terminal cash flows. So this is also opportunity cost, right? Since you sold machine before, you cannot get this the salvage value, right? So you cannot get this 800. That is what you missed this one, so it's negative opportunity cost. So this one is important, right? Opportunity cost. As here, I put this one important because opportunity cost. So, and then what? But it's not all, because what? You you can, because of not having this deduction, you also doesn't have to pay tax on that. So saved tax on old machine is 800 times 0.4, 820. So in other words, you can combine these two. After tax opportunity cost, because you are not using this 800, but this is a why 800? Because what? The book value will be 0. So 800 minus 0. So 800 is total total profit. Okay, so it's actually 800 is 800 sale price minus book value 0. Okay, and at the end of the year, book value is 0. So 800 times 0.4, 320. So you combine these two, and then again, net working capital change is what? Inventory down, so there's positive cash flow, but liabilities down is what? Negative cash flow. That means what? You have to pay cash more, so that is negative. So now this sign is reversed, right? This sign is reversed. So this problem, same as new project analysis, except that what? We add accounts payable, okay? Account payable is sign is different direction. Okay, accounts payable in the beginning was positive, at the end is negative. Inventory in the beginning is negative, but at the end is positive. Okay, because this is an asset, this is a liability, right? And finally, salvage value 1,500, right? But again, book value is 0 after just the machine is used, book value is 0. So 1,500 is totally taxable. Again, 1,500 sale price minus book value 0, right? Then you have 40%. So you can combine these two, right? So to explain, I use this way, but maybe better way is simply you can do 1,500. Maybe I'll change the color. So you can do this one, 1,500 times 1 minus 0.4, right? After tax salvage value. And this one, same thing. These two, so these two, you can combine these two. So that is what? Negative 800 times 1 minus 0.4 tax rate, 1 minus T. Then what? After tax missed sale opportunity cost, and this one salvage value is after tax salvage value. Then rather than 1, 2, 3, 4, 5 items, you can have 3 items. So after tax, the missed sale of old machine, and after tax salvage value, right? Then 1, 2, 3. So this is net working capital change. Then actually terminal cash flows are minus 800 plus 320 plus 2,900 minus 700 and plus 1,500 minus 600, right? Plus what? Plus this one. So that it is not terminal cash flows, it's net cash flows. So net cash flow equals OCF 6 plus terminal cash flows. So that's 2356.48 plus, you can do this one like 800 negative times 1 minus 0.4 is 0.6, minus 480, right? Let's store that one. Then what? 29 minus 700 is what? 2200, that's easy. Then what? 1500 times after tax 0.6, 900, right? 900 is easy. So, but just in case, store that at 2. Then recall 1 minus 480 plus, this is easy, 2900 minus 700 is 2200 plus 2200 plus recall 2, 900, 620, right? 620. So plus OCF 2356.48, 296. Oops.
Professor, you put 200 instead of 2200.
Oh, thank you. Good participation point. Yeah, you really pay attention. You're not sleepy. That's good. That's good. Thank you for paying big participation point. So I put 200 instead of 2200, so I have to add 2000 more. Oh no, yeah, 2000 more. 2000. Check. Thank you. 4976.48. So that is simply, again, this one, OCF plus all those terminal cash flows. So you can do minus 800 plus 320 plus 2900 minus 700 plus 1500 minus 600, or as I did, 23 is 56.48 plus minus 100 times 0.6 plus 29 minus 700 plus 1500 times 0.6. I think I prefer that. Then what? That's faster. Then you get net cash flow 4976. That is net cash flow 6, right? So if we now summarize, then CF0, this is CF0, C1, C2, C3, C4, C5, C6, right? And at 12%, let's just, we don't have to do that, but just quickly confirm 9940 negative 3040, enter 3616, and oops, you can just go enter again. Yeah, when you made mistake, don't panic, just 3616 again, just enter again. And C3 3001.6, enter 2632.96, enter 2632.96, enter 4976.48, enter NPV 15, enter compute 237.74. So positive, so replace. Okay. So that is, if this is on the exam, many people miss. So,
Clarifying question on the previous slide.
oh, sure. Please ask.
Can you go up to slide 19, please?
19. Oh, sure.
Okay, so you're saying the third and the fourth bullet point, instead of calculating it separately, you just use the calculation you use on the top of the PowerPoint slide where it's negative 800 times 0.6.
Yep.
So you don't need to do anything with 320 times 800 times 0.04 on bullet point number 4, like just omit bullet point 4 and just do the thing you use the top.
Exactly.
Okay.
Actually, this is, let me use a different color.
Okay.
Actually, this is, as you believe it or not, this is, if you expand this one, that is minus 800 times 1 is minus 800, right? Minus times minus is plus. So plus 800 times 0.4, and that is exactly this. Minus 800 times 0.4 is 220, right? So actually, I just combine these two, and that is, this one is exactly combining these two, right? Same thing here. 1500 times 1 minus 4 is 1500 minus 1500 times 0.4, right? And that's exactly this, 1500 minus 1500 times 4 is 600, right? So that combines these two. So that's why I recommend this way, because by doing this way, you are saving some time, right?
Oh, okay. So it only combines the 800 and the 320. So then do you still need to multiply it by 0.4? Or that's
No.
the whole equation?
Again, let me show you again. Those ones are actually square bracket. So this one it explains 320. 320 is 800 times 0.4, right?
Okay, that was the explanation. Yeah. Okay, thank you.
Thank you for asking. Yeah, that's a good point. Yeah, so that's a clarifying question. Okay, so as you know, this one is not easy. Yeah, it's lots of people miss. So, but if you practice and practice, it makes sense, right? So just practice and practice, and I think I like that. Just ask questions. You know, understanding is more important than just blindly memorize. Understanding is very important, right?
Professor?
Okay. Yep.
Can you please show again how did you got 4,976.48?
Oh, this one is nothing more than adding all cash flows, including OCF6. So OCF6 is that is like this, exactly same as new project analysis. See, terminal year, you not only have OCF, but also what? Terminal cash flows, right?
So we have a quiz at 420.
Huh?
We have a quiz at 420, right?
A quiz? Oh, check. Wow. Thank you for asking. Thank you. Big participation point. Yeah, 420. So, you know, to answer your question, you know, you just add all those operating cash flow plus all those numbers. Okay, so let me show you. Operating cash flow plus minus 800 plus 320 plus 2900 minus 700 plus 1500 minus 600. Then you get this one. Or this plus 800 times 1 minus 4 plus 900 minus 700 plus 1500 times 1 minus 4. Yeah. Okay, so time to.
Thank you.
Thank you for asking. So time to do the quiz. Password 293. 290.